Hi, this is Dr. Vicky. So in Chapter 4, we are moving on to another part of the financial statement process, which involves making adjustments. This will impact both the balance sheet and the income statement. And we will talk about the different examples of these adjustments and the why behind them, and how to book them as we've done samples in the past. So remember, we talked about two different accounting systems. One is the cash basis and one is the accrual basis. In the cash basis of accounting, generally speaking, when you're a small business owner, you are earning the cash at the same time that you're making it. But if you are a somewhat larger company and you're still on the cash basis and you receive income in the month, but you haven't delivered the service or product yet, that is called deferred revenue. It's revenue that you've received, but you haven't earned yet. So that is going to go on as a liability because someone's given you money, but you owe them services or products. Then on the flip side, when it comes to expenses, sometimes a company will pay their expenses in advance, like the rent example that we had in the last chapter, where the rent was paid 3 months in advance. So the adjustment at the end of the month, so you recorded that initial transaction when it was paid, right? You had prepaid rent for the 3 months. Now you come to the end of September and you've used some of that prepaid rent. So your adjustment is going to be to decrease your prepaid rent and increase your expenses, your debit and your credit. Your credit and your debit, depending on which side you see. Your debit, of course, is the expense, because your expenses are increasing. And then your credit is the decrease in the prepaid expenses. And then the adjustments are made to the accounting records at the end of the period to state assets, liabilities, revenues, expenses at appropriate amounts or adjusted amounts. So we were speaking about cash accounting. Let's talk about accrual accounting again for a moment. When accrual accounting happens, that's when you are using your accounts payable and your accounts receivable accounts a little more often. You also are using your prepaid expenses and your deferred revenue a little more often. Especially in the bigger companies, they are going to make those accruals or deferrals at the end of a period to make sure that the income that they receive lines up with the expenses they have for the month of actual expense, especially when it comes to rent. You don't want your income statement to keep going up and down in large waves because you've paid 3 months of rent. Some may expense that right away, and then the next 2 months you don't have anything for rent. That's not proper accounting, and although it is allowed in cash accounting for tax purposes. All right, so why are adjustments needed? A little bit more. On the income statement, we mentioned revenues are recorded when earned. Expenses are recorded in the same period as the revenues to which they relate. For example, the expenses for products. We may buy the product materials in 1 month, and then we use them in the next month. So initially, you're going to put them in your supplies account, but as you use them, you're going to make an adjusting entry to decrease the supplies account and increase your expenses. On the balance sheet, assets are reported at amounts representing the economic benefits that remain at the end of the period. And what that means is, again, using the prepaid rent expense, 3 months were paid in advance. 1 month was used. You're still going to have the benefit of 2 months worth of prepaid rent to adjust on the following 2 months. So that is an economic benefit that's going to occur, that's going to be used in the next 2 months. The liabilities are reported at amounts owed at the end of the period. So let's take a loan, for example. A loan generally has interest that accrues on it, and most of the time, part of the payment that you make every month goes to interest. Some companies may just book that entire payment to the loan or to the expense, but that's not really true. So they wait until they get their statement at the end of the month, and they adjust the liability or the loan payable to the amount, the principal amount that they see on their statement. And then the other account would be interest. So those kinds of things need to be adjusted as well. An expense or revenue has been deferred if we have postponed reporting it on the income statement until a later period. Going back to our rent example again, so on September 1st, we cash paid for rent in advance. We use up those benefits, and then on the rent, the expense is recorded then on September 30th. So what that looks like, this is another example. You have received cash for subscription in advance. Let's say you pay a subscription for games or a game program, and the subscription is delivered over the course of the month, because usually subscriptions are monthly or annually. So at the end of the month, there's going to be an adjustment needed because of that revenue that's been earned. Deferral adjustments are used to decrease balance sheet accounts and increase corresponding income statement accounts. And then each deferral adjustment, when a deferral involves an asset and one expense account, or one liability and one revenue account. So again, deferral adjustments are used to decrease balance sheet accounts and increase corresponding income and statement accounts. Each deferral will include one asset and one expense, or one liability and one revenue, like these examples here. So on the balance sheet, we may have supplies and supplies expense, prepaid rent turns into rent expense, and prepaid insurance turns into insurance expense. So here you see that your supplies, prepaid rent, and prepaid insurance would decrease or be credited. So that's the credit side of your deferral. And then on your income statement, your supplies expense, rent expense, insurance expense are all going to increase. When you have deferred revenue, then the adjustment at the end of the period would be sales revenue or service revenue. Accrual adjustments are needed when a company has earned revenue or incurred an expense in the current period but has not yet recorded it because the related cash will not be received or paid until a later period. So for example, as we incur sales, we also incur income taxes. So on September 1st, we have not incurred any income taxes yet, but at the end of the month, we need an adjustment to account for the income taxes if we've made a profit for the month. And then the end of the year, we pay cash for the income taxes. The same with interest. You earn interest as the months go along. We talked about that adjustment that is needed at the end of every month. And then cash is received for interest. This could be a savings account that only pays out one time a year. So the interest that I was speaking to before regarding a loan, similar situation. The company that you're paying is going to earn the interest. You're going to need that adjustment we talked about to make sure that your principal balance is what's on your liability, a note payable account, and your interest expense is recorded properly in the expense account. At the end of the year, there probably is not a cash transaction at the end of the year for interest on loans because you have been paying it throughout the year. Accrual adjustments are used to record revenue or expenses when they occur prior to receiving or paying cash, or to adjust corresponding balance sheet accounts. Each accrual adjustment involves one asset and one revenue account, or one liability and one expense account. It's important to remember those two combinations. In the adjustments down here, we have interest receivable. When it's received, we then we earn the interest throughout the year. So we're going to put it in our interest receivable because we have not been paid yet. Once it is paid, then we can reduce the interest receivable and increase our revenue. When we have the rent, someone is renting a home we may own or renting space in our building. So then we have rent receivable. When the rent has been earned, then it goes into a rent revenue account. So at the beginning of the month, when companies are receiving their rent, they're going to put it in a rent receivable. At the end of the month, they'll do an adjusting entry, reducing the rent receivable and increasing the rent revenue. Now, when you're looking at these, and I'm saying that your assets are decreasing and your income is increasing, don't get it confused with two balance sheet accounts. Because if you have two balance sheet accounts, of course, what you do on one side has to match what you do on the other side. Increasing, increasing. But remember, increasing a revenue is a credit, so that's your credit side. Decreasing your interest receivable and your rent receivable is also a credit. So you are impacting credits on both sides. On your liabilities, same situation. You have your income tax payable, wages payable, and interest payable, all things that are due to other companies. And you need to accrue them to ensure that those expenses line up with the income that you made in that period. For example, when your employees are working for you, of course, they work till the end of the month. And a lot of times they don't get paid for that current month until a week or two into the next month. So in those cases, those expenses you want to bring back to the current month because that's the income that impacts the income that was made in April. The April wage expense, if you took it when it was paid in May, you are misaligning the expenses with the income. So that's why an accrual is made to recognize the wages expense in the time that it was earned by the employees, and then you are actually paying it in the following month. All right, just like other transactions, we have a circle here that represents the steps that we take. We're going to analyze the transaction, record the transaction, summarize in the T accounts, just like we do with the examples in our homework for chapters 1, 2, and 3. And then we go on to prepare the trial balance as usual and report the financial statements. The trial balance sometimes is used to make notes about these adjusting entries. And one thing to note is that they are not done daily because it's just not efficient to record, let's say your rent. It's not efficient to record each day's rent as it's used. So that's why most companies will wait till the end of the reporting period, usually a month or maybe a quarter, maybe even the year. Some small business owners go to accountants with a box full of receipts and say, here, can you do my accounting? So they don't pay attention to what they're doing during the month, but normally those are cash basis, and the accountant just needs to add up everything and do the accounting one time at the end of the month. However, it's more efficient to keep your accounting on track each month so that you're reconciling bank statements, credit card statements, your loan balances. All those need to be adjusted at the end of the month, so it's better to keep up with your transactions that way. So the first step, analyzing, determine the necessary adjustments to make in the accounting period. Where are we now? The current balances. What needs to happen as far as an adjustment to be where we need to be, the adjusted balance or the desired balance, which will incorporate income when it's earned, recognizing income when it's earned, and recognizing expenses when they're used. This is very small, but this is representing some of the adjustments that we are going to be making in the samples coming up. So the first is a deferral adjustment, supplies used during the period. Of the $600 in supplies previously received, so these examples are going to sound very familiar because you're just continuing on with the same company and the same transactions. So of the $600 in supplies previously received, $250 remain on hand at September 30th. So the original transaction was increasing supplies on the asset side of your balance sheet, and then either decreasing cash or increasing a payable. At the end of the month, only $250 remain on hand, so that means that the supplies asset account needs to be $250. Remember to read these examples clearly so that you understand what exactly is happening. So this one is telling you $250 remain not used. So what that means that you take the $600 less the $250 to come up with the adjusting entry, $350. So here is a pictorial view of what I just talked about. So right now, before the adjusting entry, we have the supplies, and we have supplies expense at 0 because we haven't recognized anything yet. At the end of the month, we've used supplies, so we take down the supplies account to $350, and we increase the supplies expense by $350. Where should we need to be? Our supplies should be at $250 on the balance sheet, and our supplies expense should be at $350 on the income statement. So our supplies asset will decrease $350, and our supplies expense will, this has a negative, but this is going on the supplies expense, which is a debit. You're going to credit supplies. You're going to credit supplies and credit supplies expense. So your net income is going to be the -50. So don't let this confuse you when you see a plus here and a negative here. What this is saying, this is how it's impacting the balance sheet, the stockholders' equity on the balance sheet. Your income over here in this little bubble was 0, the expenses went up $350 and your net income is a negative $350, and that's what that is telling us. So here in our T account, we have our unadjusted balance. We take out the $350 and we're left with the $250. Our supplies expense was 0 at first. We're increasing it by $350 and the adjusted balance is $350. And this is what we refer to as adjusting for assets that are used before the adjustment and then after the adjustment. There's that $350 adjustment. And then the income is impacted, the net income, I should say, by either revenues or expenses. In this case, the supplies expense is going up $350. All right. Rent benefits expired during the period. 3 months of rent were paid on September 1st for the $7,200, but 1 month has now expired, leaving 2 months prepaid at September 1st. So when we think about this, we want to reduce the prepaid rent by 1 month so that at the end of when we complete the adjustment, we should still have 2 months worth of prepaid rent. So here on September 30th is when we need the adjustment. So a third of $7,200 is $2,400 used up as September 30th, and that's what your adjustment amount is going to be. And then what remains in prepaid rent is $4,800. This is what your analysis looks like. So your prepaid rent is going to go down and your rent expense is going to go up. Your stockholders' equity, because this is an expense, reducing net income, is going to be a negative $2,400. This is what the journal looks like. Rent expense is your debit. The normal balance on expenses are debit balances, so it's going to increase $2,400. Your prepaid rent is going to decrease by the $2,400. And then your T accounts, you're going to reduce the prepaid rent, and you have what's left, the $4,800, and you're going to increase the rent expense, the $2,400. Depreciation is recorded when we use equipment. And what depreciation is, let's go back to the equipment that we purchased. In this case, the computer equipment. It was estimated to last 2 years and has now been used for 1 month, representing an estimated expense of $400. So depreciation is a method that we allocate the cost of buildings and vehicles and equipment, anything that is considered long-term assets that are usually used more than a year. For example, the depreciation on a building, if you pay for it, is 27.5 years. Depreciation on cars generally is 5 years. Depreciation on big equipment could be 5 to 10 years. According to tax standards, the usual amounts are 3, 5, 7, 10, and 27 years. And normally speaking, any kind of asset falls into one of those categories. GAAP, however, recognizes depreciation in simple terms, meaning if this computer equipment is good for 2 years, so you're going to have 24 months, and I can't remember how much we paid for it. Let's see. So we paid $9,600. That might ring a bell from your the example that we used in one of the last chapters. So $9,600 on computer equipment. And again, it's supposed to last 2 years. You take that $9,600, you divide it by the 24 months because we are accruing, we are accruing the expense as we move along. So now it's been used for 1 month. So rather than showing a change in the equipment we always want to leave the cost visible, because we always want to understand how much we paid for equipment, computers, a building, whatever. What is done for these kinds of depreciation and amortization is a contra account is created to hold the depreciation. So what it does, a contra, means that it offsets what it relates to. So this contra account will offset the asset account for computer equipment. And it looks like this. So on your asset, on the balance sheet, your original cost of the equipment is the $9,600. We're going to recognize $400 for depreciation. So the net accumulated, the equipment net of depreciation is $9,200, or the current carrying value, or the book value. Okay, this is not a value, let's say that, okay, I can sell it for this. No, you don't want to consider that. You want to consider the equipment itself. This is just a way for companies to expense what they are paying for their equipment, their long-term equipment. So the balance sheet is impacted. The contra account, because we are offsetting the asset. So the assets, remember, the normal balance for an asset is a debit balance. So the normal balance for contra accounts is a credit balance, because it's reducing the value of the asset that it impacts. So rather than saying that it is decreasing, it puts it in this notation, plus XA, meaning this is a contra account. It's an account that is related to an asset specifically. And then your depreciation expense, similar to other expenses, it's going to decrease stockholders' equity because it's decreasing. It's taken away from your revenues to create a net income, or in this case, since there's no revenues, a net loss. So the stockholders' equity is impacted by a increase in expense and then a decrease in stockholders' equity. Here is your journal, depreciation expense. Expense normal balance is a debit, so we're debiting the $400 there. Then on the stockholders' equity, the end result is that it is a credit balance, so it's a negative $400 there. But you don't remember the impact on the stockholders' equity is only here for your information. If this is confusing you, just pretend it's not there. Okay. Then your accumulated depreciation, remember, is going to the contra account, which is a credit. So we're going to increase that by $400 as well. And what this negative A means, that the contra account is increasing, but it is actually reducing the cost of the item. Or in other words, total assets are decreased by the $400. And here are your T accounts. Your accumulated depreciation increases by $400. Your expense increases by $400. And your adjusted balance for your equipment is the $96. There's no entry here, but the book value would be the $9,600 less the contra account over here, so it would be $9,200. Accumulated depreciation is the balance sheet account. The depreciation expense is the income statement account. The accumulated depreciation will eventually be the total amount paid for the equipment. So accumulated depreciation would equal at the end of the 24 months its original cost. The contra account opposes account it offsets, meaning it's going to reduce the account that it offsets. The depreciation amount, when it says depends on the methods used, there are various different kinds of ways to determine depreciation. But many times companies just use the simple form, which is you take the number of months or number of years, calculate the depreciation for the month or the quarter, however they do that, however they want to do that kind of transaction, and that's how the depreciation amount is determined. All right, amortization, similar to depreciation, but it is used for items like software, like trademarks, copyrights, things like that that are not tangible. We call that amortization. But it has the same impact, same idea as depreciation. So the F software that Noodlecake had developed estimates that it's estimated to have 3 years of usefulness, meaning people are going to use it for 3 years and then new stuff's going to come along and the use of it is going to go down. So now it has been used for 1 month at an estimated expense of $250. So again, we create a contra account, which is which is amortization. And it's a contra account because it's reducing the value of the software without removing the actual cost from the balance sheet. So you're going to see that in a moment. And then the amortization expense, like depreciation, all other expenses, is increased. And then the stockholders' equity is decreased because it goes down. In journal form, we have the expense, increasing the expense, decreasing the stockholders' equity for $250, and then the accumulated amortization is going in the contra account that ultimately on the balance sheet decreases the total assets. And if you remember, we paid $9,000 in that contract that we signed, and there was no transaction for initially, but then we paid for the software, and we were able to book that amount of $9,000 for the software. So now we're going to create the accumulated amortization account. It's going to first have $250, and then subsequently each month after for 3 years, it's going to have the same adjusting entry. Gift cards. So most holidays, gift cards run rampant as gifts. But when someone pays for a gift card, they're giving the company $100 to hold on to until the person actually uses the gift card. So that's a liability to the company because now they owe customers the value that's on their gift cards. So these are transactions that we call deferred revenues because we've received the cash before we've earned it. So in this situation, our deferred liability is going to be $100, and our stockholders' equity is going to go up because we're recognizing revenue. So let's back up just a moment. So the example that I gave you was when customers paid for the gift cards. So that transaction itself would have been before this transaction, because now it comes to the company accepting the gift card as payment from the customer. So now the deferred revenue that was booked previously is being lowered because now they're recognizing this $100 because the customer has used their gift card. The deferred revenue is going to go down. Your sales revenue is going to go up, which ultimately makes your stockholders' equity go up. So this is one of those transactions where one side goes down and the other side goes up. Your deferred revenue is going to go down, and your liability and your debit side. Your sales revenue is going to go up for 100. And then your T accounts in your deferred revenue, it was originally $300. Remember that from one of the homeworks before. We're using 100 of that, and now that balance remains at 200. And then the sales revenue, the unadjusted balance, they had $1,200. They recognized the gift card revenue that they previously booked as deferred. Now they're recognizing it because it was used. Services given, but revenue not yet recorded. We see this a lot when it comes to consulting services or accounting services. So Noodle Cake provided $32.50 of consulting service to other app developers in September, with payment to be received in October. So they trusted this company by giving them the consulting services and agreement to be paid at a later date. So the accounts receivable goes up. So this is a benefit, an asset that is for future use. Your service revenue is being recognized because the work has already been done. They've already provided the consulting services. They just have not been paid for it yet. So your journal looks like this. Your accounts receivable goes up, and your service revenue goes up. Accounts receivable, the unadjusted balance was $500. We now are recognizing another $32.50 because of work done in the month, and we expect to receive it next month. So that is our receivable, our expected benefit. And then our service revenue is earned because we've already done the work, so it's going on your service revenue. We talked about wages incurred but not yet recorded. So Noodle Cake owes $1,950 of wages to employees' work done in the last 6 days of September. So this is a case where the employees worked, they've done the work, they are owed the money, but they don't get paid until the next month. So how we work that is we have a salaries and wages payable account. So we booked this $1,950 in this payable account, but we recognize the expense because the employees have already worked. Those last 6 days is being accounted for here as an expense. And this is showing you the salary and wages expense goes up and the wages payable goes up. Same thing in your T accounts. Interest expense incurred, but not yet recorded. So this is going back to an example I was talking about before when it comes to interest and notes payable. So the company has not paid or recorded the $100 in interest that it owes for this month on its note payable. So it's going to increase interest payable by $100, and then increase the interest expense by $100. Now, in this case, the company already knew how much interest was going to be charged, so it did not have anything to do with the loan payable account. It only hit the interest payable and the interest expense. So your journal is going to look like interest expense goes up and your interest payable goes up. Income taxes incurred but not yet recorded. This has to do with income that we received during the month, less the expenses. We are going to come up with, hopefully, a net income at the end of the month. We know as a company that we will owe taxes on that net income. And then we also should know or have a reasonable expectation for our percentage rate of taxes. So for noodle cake, it's equal to around 20% of the company's income before taxes. So here we have $15,350 for revenue. We have less $8,900 for our expenses. So the $15,350 less the adjustments equals $1,000 in adjusted income before the tax expense. So what this is saying is, initially the revenues were at $12,000 and the expenses were at $8,900. Doing these adjusting entries brings the totals now to $15,350 in revenues and $14,350 in expenses. And this is what the accrual deferral process does. We are making sure that we're booking expenses in the month that we used them, and we're booking income in the month that it was earned. Remember, this has nothing to do with whether cash was paid or received. So at the end of the month, the net income comes to $1,000. Tax rate is 20%. The income tax that will be booked is $200. And the way that's booked, similar to the wages payable, we have an income tax payable of $200 and income tax expense of $200. All right. So very tiny and probably hard for you to see on your end, but here are all the T accounts listed out. Lists all of these adjusting entries. So remember, the journal entries never involve cash because these are things that we are adjusting, not because we received or paid out any cash. It's just because we are determining what expenses go with the income that we earned for the month. So we may have deferred income that we've received cash, but that the cash transaction is not the adjusting entry. The cash transaction is done when you receive the cash. You may, at the end of the month, if the cash isn't booked to a deferred revenue already, at the end of the month, you need to recognize how much is still owed to the customer, how much in services or product is still owed to the customer. Each adjusting entry always includes one balance sheet and one income statement account. This is always the case because what you're doing is adjusting revenue or adjusting expenses for those that the expenses need to match the income that it refers to. For example, the inventory, if we are a retail company and we have a load of inventory on a balance sheet, at the end of the month, we're going to have an amount for to write off that inventory as cost of goods sold. So that is your inventory account and your cost of goods sold expense. When it comes to the income, when you receive cash, but you haven't earned it yet, you're going to defer that income. Generally, when you receive the cash, you're going to defer that income. But now you've come to the month where it's been earned. So you're going to reduce the deferred income account and increase the revenue. And that's where the one balance sheet and one income statement accounts come into play. Now we're going to prepare the trial balance. You notice here that these items are at the balance as of September 30th as it stands. We have our list of T accounts. And this is where you're going to see the balances on where they should be. Now you're going to prepare the adjusted financial statements. Here's the service revenue that was recorded as deferred revenue. Your retained earnings at September 1st was $0. Your net income is $800. And that's coming from your income statement. Here are the balance sheet accounts at September 30th with your assets. And again, this is your trial balance. So you're showing your income statement and your balance sheet. You're showing your total assets and your liabilities and stockholders' equity. And then your retained earnings comes from your income statement. Your current assets and your current liabilities are the $25,700 and the $13,150. Remember, you're going to divide the $25,700 by the $13,150 to get your current ratio, which helps creditors understand if you're at a good position to pay your bills. You have your accumulated depreciation in your software, amortization. So the net is going to be the $9,200 and the $8,750. So this is how this is laid out. You put your calculation, your original cost and depreciation to the left of the total column, and you're going to bring your total over here. Same with amortization. You're going to have your cost and your amortization expense, and then you're going to bring the net total over here. Your retained earnings, as we already mentioned, comes from our net income. So then we go through a process of closing the books. So the last step in the accounting cycle is referred to the closing process. This is performed usually at the end of the year after the financial statements have been prepared. The closing process cleans up the accounting records to get them ready to begin tracking the results for the following year. It also helps to get it done sooner than later so that companies can get their tax returns done. So the first thing is they're going to transfer all of their net income or loss dividends to retained earnings. And that's why we always see the impacts to retained earnings, which impacts the stockholders' equity, because even though we don't post to the retained earnings account and we don't post to the stockholders' equity, the amount is being impacted by every transaction, whether it's a revenue or an expense. Every transaction that hits the income statement ultimately impacts the stockholders' equity. So we prepare the post-closing trial balance, we prepare the closing journal entries and post to the accounts. We prepare back this up a minute. We're going to analyze the transactions, prepare the journal entries and post to the accounts, prepare unadjusted trial balance, and then prepare the adjusting journal entries and post to the accounts. Prepare the adjusted trial balance and then prepare the financial statements. So these two items here are what you did in chapters 1, 2, and 3. You're going to analyze the transactions, prepare the journal entries for the normal transactions that happen during the month. Those items in blue we do at the end of the month because we're reconciling bank statements. We're making sure that we've captured all of the expenses that came out of our cash, all of the revenues and expenses that we need to account for. Then we're going to adjust those deferred revenue and expense accounts so that, again, we are recognizing expenses in the period that the revenue was earned to spend those expenses. Okay. One example, again, is your utility bill. You don't get your utility bill until the following month, but you're using services along the month. So when they get the invoice, they might post it in a payable account in the month that they get it, but then they're going to do an adjusting entry to bring that expense back to the month that it was used for. That's what's called accrual accounting. Combining or moving expenses into the proper periods that align with the month that they were used. And then finally, you're going to prepare closing journal entries for the year, and then prepare post-closing trial balance. You're going to transfer the net income or loss and dividends to retained earnings and establish zero balances in all income statement and dividend accounts. Now, this process of establishing a zero balance with software that we have today, this is not something that you normally have to do, that you would have to physically do. The accounting systems that are in place right now, even QuickBooks, they do it automatically. What they don't do automatically is move the retained earnings, the net income, into the retained earnings. And ultimately, those retained earnings could be dispersed either as dividends or as a disbursement to the owner. All right, closing temporary accounts. So our temporary accounts are the expenses, revenues, and dividends because we only incur revenues and expenses for 1 year at a time. At the end of the year, all of those accounts are going to go back to zero because now we're on a new year. Could be a new fiscal year. Some companies have a year where it starts from October 1st to September 30th. So whatever the fiscal year or the calendar year is, those are expenses that are accounts that are temporary accounts. They track financial results for a limited time period, usually a year. And then you have your permanent accounts, liabilities, assets, and equity. Permanent accounts track financial results from year to year. So with this being said, this is why we have the different time frames on the income statement and the balance sheet. So your balance sheet, remember, is an as of date. It's as of a particular date, a particular point in time. When we're talking about the income statement, it represents a larger period of time. So it could be year to date, September 30th, which would include all 9 months. It could be the month of September. Generally, we don't do daily because that's just not efficient. We do periods of time, usually a month, could be a quarter, or even a year. Just depends, again, when the company needs their financial statements completed. Closing temporary accounts just means that there are a couple of journal entries that need to be done. This is what is done systematically in the software: debit revenue accounts and credit expense accounts. Debit or credit the difference to retained earnings. Credit dividends declared and debit retained earnings. These are a couple of the transactions that could be done. So your closing entries, you have your sales, your interest expense, all of your expenses over here, and then your retained earnings increases the $800, which is the net income, as we've seen on the income statement. So your retained earnings needs to be adjusted for whatever dividends are going to be paid. So we have that transaction, and then after posting all of these closing entries, all of the income statement accounts and the dividend account will have a zero balance. The T accounts go back to zero, and there is no more expense. If you were to run an income statement on January 1st, you'd get all zeros. So the final check that all debits still equal credits and that all temporary accounts have been closed is that you run an adjusted trial balance, and you see that at the end of this period, all of this has turned to zero, which if this is all turned to zero, then at September 30th must be their fiscal year-end closing. So now, starting October 1st, these accounts will generally start to increase. And then you should see only balances in your permanent accounts, which are your assets and liabilities. All right, we touched on these subjects a little bit through the lecture. So adjustments help to ensure that all revenues and expenses are reported in the period which they are earned or incurred. Without adjustments, the financial statements present an incomplete and misleading picture of the company's financial performance. And this is why it's really important that even small companies should really do accrual accounting, because it helps to match and be more consistent from period to period the income and the expenses that are incurred or earned. All right, so that ends the chapter. If you have any questions on any topic that I have discussed here, please, again, feel free to send me a text or an email letting me know you'd like some one-on-one time, and we can get together. I certainly have time for you, and I want to see you succeed. All right. Thank you. Have a great day.